Hello and welcome to this video. In this video, we are going to do a A-level accounting question from paper 4 Feb-March 2024 question 2. The question states that SPLC operates a system of standard costing. It provided the following budgeted data for January 2024. Production and sales 8,000 units with a selling price of $68 per unit. Direct material 3 kilos per unit costing $4 per kilo. Direct labor 4 hours per unit paid at $6 per hour. Fixed overheads charged at $2.5 per direct labor hour. In January 2024, only 7,000 units were produced and sold. In the A bit of the question, we are asked to prepare for January 2024 in a columnar format the fixed budget and the flexible budget statement. And the answer should include the fixed budgeted profit or loss for the month and the flexible budgeted profit or loss for the month. Let's do all our calculations in our working notes, then we will proceed and make the fixed budget and the flexible budget statement. You see, the information which was given for fixed budget was the production and sale was of 8,000 units and the selling price per unit was $68. So our sales will be 8,000 times 68, which will be $544,000. Direct material 8,000 units, and for each unit we require 3 kilos of direct material and the price per kilo was $4. So it will be 8,000 times 3 times 4, which will be $96,000. Direct labor 8,000 units, and for each unit we require 4 labor hours and the rate of labor hours per hour was $6. So it will be 8,000 times 4 times 6, which will be $192,000. Fixed overhead was 8,000 and this was calculated on the basis of labor hours. So we have 4 labor hours for 1 unit and the price per hour was given as $2.50. So it will be $80,000. Flexible budget will be based on the actual production and sales, and actual production and sales was for 7,000 units. So our sales now will be 7,000 times $68, which will be $476,000. Direct material will be 7,000 times 3 times 4, which will be $84,000. Direct labor will be 7,000 times 4 times 6, which will be $168,000. Fixed overhead will be 7,000 times 4 times $2.50, which will be $70,000. Now let us make the fixed budget and flexible budget statement. So we have to find the profit. So how do we find the profit? From the sales revenue we subtract all the expenses, direct as well as indirect expenses, and we get the profit. So we'll start with the sales revenue, which we have calculated for fixed budget as $544,000 and for flexible budget as $476,000. Then the direct material, for fixed budget it is $96,000 and for flexible budget it is $84,000. And then the direct labor, for fixed budget it is $192,000 and for flexible budget it is $168,000. And then the fixed overhead, which we have calculated, for fixed budget it was $80,000 and for flexible budget it was $70,000. So from the sales revenue, that is for fixed budget we have $544,000, we subtract $96,000, then we subtract $192,000 and then we subtract $80,000. We get the profit for fixed budget as $176,000. In the same way, for flexible budget we'll take $476,000, from there we subtract $84,000, then we subtract $168,000 and then we subtract $70,000. We get the profit as $154,000. Furthermore, we have additional information. Actual results for January 2024 included the following. Direct material, the price was $82,460 using 3.1 kilo per unit. Direct labor $182,700 paid at the rate of $5.80 per hour. In the B bit of the question, we are asked to calculate the following variances. First, direct material price variance. The formula for direct material price variance is equal to standard price per kilo minus the actual price per kilo times actual quantity in kilos. Standard price per kilo was given as $4. Actual quantity of direct material in kilos, we are producing 7,000 units and for each unit we require 3.1 kilo. So it will be 7,000 times 3.1, which will be 21,700 kilos. And the actual price per kilo, we are paying $82,460 for 21,700 kilos. For 1 kilo, how much? So when we cross multiply this, it will be 82,460 times 1 divided by 21,700. We'll get the value as $3.80. Now we will apply it in the formula. Direct material price variance will be equal to the standard price per kilo, which was $4, and the actual price per kilo, which was $3.80. So when we subtract this, we get 20 cents, and we'll multiply this with 21,700. We'll get the value as $4,340, and this is the favorable variance. Next, in the bit 2, we are asked to find the direct material usage variance. We have the formula for direct material usage variance will be equal to flexible budgeted quantity of material minus the actual quantity of material times the standard cost per kilo of the material. You see, we know the standard cost per kilo of the material, which was given as $4. The flexible budgeted quantity of material, we are producing actually 7,000 units and the standard was 3 kilos. So 7,000 times 3 will be 21,000 kilos. So the flexible budgeted quantity of material is 21,000. The actual quantity of material which have been used was 21,700 kilos. That is, we have used 700 kilos more than what we have budgeted. So this will be negative 700 times $4. We get $2,800, and as this is negative, it is adverse variance. In the third bit of the question, we are asked to find the direct labor rate variance. Direct labor rate variance is equals to standard labor rate per hour minus the actual labor rate per hour, and we multiply this with the actual direct labor hours. So we have the standard labor rate per hour, which was given as $6. We have the actual labor rate per hour, which was given as $5.80. We don't know the actual direct labor hours which have been put in. We have been given that we have $5.80 for 1 hour, and we have paid the total amount for the direct labor as $182,700. So this will be equal to how many hours? So when we cross multiply this, it will be 182,700 times 1 divided by $5.80. We get the value as 31,500 hours. So now we will put it in the formula, that is direct labor rate variance will be equal to $6, which was the standard rate. From there we subtract $5.80, which was the actual rate. We get 20 cents, and we multiply this with 31,500. We get a favorable variance of $6,300. In the fourth bit of the question, we are asked to find the direct labor efficiency variance. For direct labor efficiency variance, we have the formula, which is flexible budgeted labor hours minus the actual labor hours, and we multiply this with the standard labor rate per hour. So the flexible budgeted labor hours, we have to calculate this. It was given that they are actually producing 7,000 units, and for each unit the labor hours which was required was 4. So 7,000 times 4 will be 28,000 hours. So now we'll find the direct labor efficiency variance, which will be equal to 28,000 minus 31,500, which will be 3,500. That is, we are using actual labor hours more than what we have budgeted. So it will be minus 3,500 times $6. We get an adverse variance of $21,000. Furthermore, additional information is provided which says that the actual fixed overhead for the year amounted to $78,000. The fixed overhead expenditure variance was $2,000 favorable, and the fixed overhead volume variance was $10,000 adverse. In the bit C of the question, we are asked to explain why the fixed overhead volume variance was adverse, and we have to consider the subvariances of fixed overhead volume variance. However, calculation of these are not required. It is mentioned that the calculations are not required. However, I am going to do the calculation and show you how the variance and the subvariances have changed and why it was an adverse variance. And then we will proceed and answer the question. Just for understanding, we are doing this calculations. So we know that the fixed overhead volume variance have a formula of flexible budgeted hours minus the budgeted hours times the budgeted OAR, that is overhead absorption rate, and this was already given that the fixed overhead were absorbed on the basis of labor hours and the rate was $2.50. So now if we see the flexible budgeted hours, these are calculated by taking the actual production, which was 7,000, times the labor hours which was required for 1 unit, which was 4. So we got this as $28,000, and the budgeted hours, according to the fixed budget, we were producing 8,000 units, and for each unit we require 4 labor hours, so this was $32,000. So we estimated that we will produce 8,000 units. However, we were able to produce only 7,000 units. So because of this change in production, we got an adverse fixed overhead volume variance as $10,000. That is, out of this, if we take this difference, it is 4,000 times $2.5, which will be adverse $10,000. Now fixed overhead volume variance will be divided into two subvariances, which will be the fixed overhead capacity variance and fixed overhead efficiency variance. In fixed overhead capacity variance, we take the actual direct labor hours, from there we subtract the budgeted direct labor hours and we multiply the OAR. So the actual direct labor hours, which was calculated in the bit B, third bit of the question, as 31,500 hours, and the budgeted direct labor hours was 32,000 hours. So when we subtract this, we get minus 500 and we multiply it with $2.50 and we get minus $1,250. This is adverse because it shows the under absorption of overheads. And then for fixed overhead efficiency variance, we have the formula that flexible budgeted labor hours, from there we subtract the actual direct labor hours and then we multiply it with OAR. We get this by taking flexible budgeted labor hours, which was 28,000 hours. From there we subtract 31,500 hours. We get negative 3,500 and we multiply it with $2.50. We get negative 8,750. Again, this is an adverse variance. Why? Because this again shows that there have been under absorption of fixed overheads. So now when we answer the question, we are going to mention why there was an adverse variance, because of the difference in the labor hours. So that is what we are going to write in the answer. So now we are going to mention that the fixed overhead volume variance was adverse. Why? Because the actual production, which was 7,000 units, and this was less than the budgeted production, which was 8,000 units, and because of this we got the fixed overhead volume variance as adverse, and we have also seen the calculation. Then we have the fixed overhead capacity variance, which is a subvariance of fixed overhead volume variance, and this was also adverse. Why? Because the actual hours worked was less than the fixed budgeted labor hours. The actual labor hours was 31,500 hours, whereas the fixed budgeted hours was 32,000 hours, and this difference have led to an adverse fixed overhead capacity variance. Furthermore, the fixed overhead efficiency variance was also adverse. Why? Because the actual hours worked were greater than the hours of flexible budgeted statement. We have seen the actual hours was 31,500 hours and the flexible budgeted statement hours was 28,000 hours, and this difference led to an adverse fixed overhead efficiency variance. Next, we have additional information which states that the company has been preparing sales, production, purchases and labor budgets for several years. It has been suggested that the company should also prepare budgets for the trade receivable and the trade payables. In the debate of the question, we are asked to advise the directors whether or not the company should start to prepare the budgets for both trade receivable and trade payable, and we have to justify our answer. You see, when we make the trade receivable and trade payable budget, we will be aware when our debtors are going to pay and when we have to pay to our trade creditors. So we will be aware about the cash inflows and cash outflows, which will in turn help us to make the cash budget as well as the master budget. Furthermore, this can be used as a benchmark to monitor the performance of the credit in the company, and most of the profitable business fail. Why? Because they faces the liquidity crisis and it will lead to insolvency. So cash is a very important factor which have to be considered when we want our businesses to be successful, and this can be achieved with the help of the trade receivable, trade payable budgets as well as the cash budget. However, if a company is buying and selling only on cash basis, that is all the sales are on cash basis as well as all the purchases are cash purchases, then there is no need to make the trade receivable or trade payable budget. But this does not happen in most cases, because to be competitive enough, they usually sell the products on credit basis, and to have additional liquidity available in the business, usually the businesses purchase on the credit terms. So trade receivable and trade payable is a very important part of almost most of the businesses. So for these businesses we require to make this budget, but if it is on cash basis, then naturally it's not required. And moreover, it may be a bit time consuming, because now when they make the trade receivable and trade payable budget, we may need to allot this work to a person, and this may increase the administrative cost. However, as the overall time consumed for making the cash budget and the master budget will be reduced, so this can be overcome. Furthermore, the budget won't make the trade receivable pay the money back, or it does not help in getting the irrecoverable debt back, but still it helps us to have a proper monetary system for the credit control, and it does not ensure that the enough cash is available to pay the trade payable. So these may be the drawback, but when we consider the drawbacks, the advantages are more, and as the advantages or the benefits which we get when we make the trade receivable and trade payable budget as well, so I suggest that they should make both the budgets so that this will be more beneficial for the company. With this, we have completed this question.
Thanks for watching my videos. Have a peaceful and blessed life.